Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm Mark Bunting, the host of RCTV. Thank you very much for being with us today. If you have any questions for our guest today, Larry Lepard, you can put them in the comments section and we'll get to as many as we can toward the end of the show. As mentioned, Larry Lepard is our guest. He is the managing director at Equity Management Associates. He is also the author of The Big Print, and the subtitle of that book is What Happened to America and How Sound Money Will Fix It. Let's bring him in. Hi, Larry. Thanks for joining us today.
Hey, Mark. Nice to be with you. Thanks for having me on your program.
Now, I watched an interview with you a while ago, and you had your little dog in behind you. I can't quite there.
Yeah, she may come back. My wife just took her out for a walk, so I don't know. She might be back in 20 minets or so.
No, she behaved very well, and then she sort of wandered off towards the end, but that was kind of fun to watch her.
Yeah.
Now, let's kick things off here, Larry. You've mentioned the fourth turning on a number of occasions, and that's a book by Neil Howe that he recently updated called The Fourth Turning is Here. And these are events that come around every 80 to 100 years, and they're very disruptive politically, socially, and otherwise. And so what's your understanding of a fourth turning, and how and why does it always result in disruption and crisis?
Well, yeah, I think you described it well. I mean, I think societal systems get set up in the first turning, which is, the cycle is one of, the birth of a new system, and then it grows, matures, gets corrupt, and then breaks, and then there's a new system. And it tends to happen every 80 to 100 years. And the last one before this was, the last fourth turning was the Depression / World War II. The one before that was the Civil War, and the one before that was the American Revolution. They're each kind of 80 to 100 years apart. And I think we're in one now, post World War II. We had a sound economy, sound system, sound money. We were still on the gold standard, quasi gold standard. And, a lot of good things happened, kind of 50s, 60s, 70s. Some bad things happened too, but in general, it was pretty stable society, good middle class growth, et cetera. A lot of, wealth was created. And then over time, what happens in these societal systems is things start to break and get corrupt and messed up. And then ultimately there's kind of a revolution or a big period of change. That's what, they call in the book, the fourth turning. And we're in that right now, Mark. And my belief is we're in it because the money is broken. And we're seeing that, in the price of gold right now. And we're seeing it in all the inflation that we've endured. And it's, to me, the issue, the critical, I mean, each of these prior fourth turnings, they solved a different issue, right? World War II was, defeating fascism. The Civil War was slavery and the division of states and the central government. And then American Revolution was splitting from Britain. So in my opinion, this fourth turning is about what is money. In 71, we transitioned to a complete fiat system. There are no countries in the world that have money based on sound principles anymore. Gold and silver are not, fiat currency is not backed by gold and silver. So, and that worked for a while, but it's gotten worse and worse and worse. And now we're at the point where it's really a crisis, and something's going to happen. We're going to have to resolve it. We're going to have to return to a sound money standard. And so I wrote the book to try to communicate that, how far we are along in the crisis, and then how people could protect themselves. And then also to talk a little bit about, what are some of the things we should be looking for, and how to try and influence the politics so that we go to sound money sooner rather than later. Because the sooner we get there, the better off, the problems we have right now, we can fix, but they do need to be fixed, right? So.
Right. Now, your book is essentially broken into two parts. The first part is the problem, the broken monetary system. The second part is you've got some solutions. But let's just start with the problem. How do
Sure.
you think that monetary policy over decades has resulted in a massive loss in purchasing power of the U.S. dollar and created a huge wealth gap?
Yeah, sure. It's a great question, and it's a slow, steady erosion, right? I mean, it started with the creation of the Federal Reserve, and that allowed fractional reserve banking to grow much more aggressively. And fractional reserve banking grows the money supply and creates underlying inflation. But and it got worse in '71 when Nixon took us off the gold exchange standard. We were never really on a full gold standard after '33 when Roosevelt grabbed the gold, but so it got worse in '71, and then the bailouts started, and what we used to have kind of capitalism based on sound money, and what we've now got is kind of crony capitalism based on unsound money, and it's gotten very, very extreme, to the point where the book's called The Big Print. Well, we've actually already had two big prints. One of them was in '08, where they grew the money supply $3 trillion, and the other one was in 2020 where they grew the money supply $5 to $7 trillion in a very short period of time. So it's there were steps along the way, the bailouts, it started with LTCM cracking in 1998, and the Fed and the Wall Street firms coming to the rescue of that. And then they cut rates down to almost 1% or almost 0%, 1% after the bursting of the dot-com bubble. And that led to the housing bubble. And then of course that led to an even bigger bailout where they took interest rates down to zero and held them there for 7 years. And each step along the way, I mean, in 2000 they got rid of Glass-Steagall, so the act that separated banks from commercial banks. At every step of the way, they've cheated and made the laws more lenient and favorable for the bankers and the money people. And you mentioned wealth inequality. Let's talk about that. The reason that has occurred is the system is crony capitalist, unfair, such that you and I, if we want to borrow money, we have to borrow it on a credit card, and we pay 25%. But the privileged actors at the big firms and Wall Street players and hedge funds and so on, they're all able to borrow from the Fed or very close to the Fed at in some cases almost at zero cost, because interest rates were zero, and now at a higher cost, but still at rates that are much more advantaged compared to the average citizen. And so the average citizen is really getting screwed. And we all know that because we all go to the supermarket, and we see what the price of everything is. And so people kind of wonder, and the politicians try to say, well, all these prices are high because of greedy corporations, which is complete nonsense. These prices are high because the government and the Fed and the banks are all in cahoots with each other, and they print money to bail themselves out, and they all do pretty well, but we all pay for it. So it's that simple. And the book tries to lay that out. I try to walk through all the steps. I mean, I have the advantage. I'm 67 years old. I have the advantage of being alive and being in the monetary world that whole time and watching it unfold. And I think, some people who are younger maybe weren't here when some of these things happened. And so I'm able to kind of lay out that history and explain how we went from somewhat broken to what I would call now massively broken, the system, the monetary system.
Now, Larry, you said that you're on a mission for sound money, i.e., gold, silver, Bitcoin as a legal tender, and you admit that some of your solutions are on the radical side, such as getting rid of the Federal Reserve entirely. So could you run us through a few of your solutions and maybe the probabilities that ultimately may come to fruition?
Yeah, that's both really great questions. I mean, there's a chapter in the book called Policy Responses, and I actually wrote the speech that I think the someday president should give. And the three big things it called for were that first, that all forms of money would be treated equally. So the dollar, gold, silver, and Bitcoin would all be forms of money, and none would pay capital gains taxes. So if your value of your gold went up in dollar terms, you wouldn't be taxed on that. And same is true of silver and Bitcoin. Then I said we need to get rid of the Federal Reserve. And of course, that sounds very radical, but we actually operated, the country did okay between 1789 and 1913. We didn't have a Federal Reserve. They'll try and tell you that there are all kinds of panics and the banks were unstable, et cetera, but it's nonsense. I mean, the country made enormous progress in that time frame, and the book details that. And then the third step of my proposal is that we need to eliminate the FDIC, which is kind of a joke anyway. And They used this in the Silicon Valley Bank failure, where they said, look, if we let this bank fail, all the banks are going to fail. And so we got to print money, and we've got to, bail this bank out. And, banking is like any other business. Banks should be conservative. They should be well run. If they're not well run, they should fail. And, the FDIC creates moral hazard by making everybody think that they're safe when they're really not. And the only way they're safe is that they're going to print enough money to bail them out. And that money printing is really a theft from everybody who's saved money. One of the things, Mark, that's really tragic is that, when COVID came along, if you've been working on your life and you'd saved some amount of money, within 2 years, 40% of the purchasing power of that money went down, went away because of the price of, your groceries and everything else went up. And that's pure, we bailed people out with this purchasing power protection, purchasing power program and stuff. We bailed people out, and everyone kind of thinks these bailouts are free, but they're not. I mean, they are why we have inflation. And so we have to put an end to that. And to your question about the probability of this happening, obviously right now, today, where we stand, of course not, none of this is going to happen because nobody's really even aware of the problem. Again, why I wrote the book. But what I would say is that, as the problem gets worse and inflation gets worse, more people become aware of it. And perhaps we even have a real currency event, i.e. a very, very high, a period of very, very high inflation, or perhaps at the extreme, even hyperinflation. People are going to become aware of it. And when they do, they're going to demand a solution. And so someday, somewhere, somehow, a politician is going to stand up and say, hey, you know what? The reason our country has gone to shit is because we have, unsound money, and we're going to go back to the gold standard, or we're going to go back to some quasi, fixed neutral asset standard, including possibly Bitcoin or oil or other things. But oil's not a good one. But the point is that we're going to go back to something where the money is sounder than what the Federal Reserve can just run off a printing press. And if we did that, the world would be a much better place in every respect. And it's very optimistic. I'm very optimistic. The first part of the book is kind of gloomy. It's like, this thing's pretty well broken and it's getting worse, and that's kind of sad. But the second part of the book is extremely optimistic and positive because, we are moving towards this thing coming to a head. And when it does, we'll fix it. And when we fix it, on the other side of it, it'll be much better. My kids and grandkids will have a much better world. So, we're going in the right direction, but, how it happens it's a matter of politics and time and what happens in the markets. And my sense is it's going to take another 10 years. But I think that sometime in the 2030s, we're going to be back to a sound money standard.
All right. Very interesting answer. Really fascinating stuff. Now, Judy Shelton wrote a book called As Good as Gold. I'm assuming you're familiar with it. And in that, she argues that the U.S. should come out with a Treasury bond that is backed by gold. Do you agree with that? And
I totally agree. Yeah, no, Judy's
consider that. Do you think?
Yeah, I read Judy's book, and Judy's a friend, and that's a brilliant idea. It makes a ton of sense. The only way governments are going to have credibility to borrow money is if they borrow it in sound money terms. In a parallel thought, there are others who've talked to a guy named Andrew Hone, thought of the idea of doing a government bond, with a Bitcoin yield of some sort, so that, basically people would buy it to share the upside in Bitcoin. And that's what Judy's talking about, sharing the upside in the gold with these bonds. And yes, they're both great ideas, and they would both lead to, a way of the U.S. getting out of its massive debt trap. Because, right now we have more debt than we could ever pay back. And eventually that could become a very big issue. And particularly if the Fed is forced into, the next big print and further monetary debasement, we're going to have a lot of inflation. And I can't really see, the only way out of this whole mess that I see is some kind of a grand monetary reset. We need to, the bonds aren't worth what they say they're worth. They're just not. There are too many obligations against the money. So as a result of that, what we need to do is mark the bonds down. And the way, when you do that, that's effectively inflationary. So what needs to happen is there will be one very large burst of inflation, which is, in my view, will be painful, but better than, 20 years of just continued, bleeding out inflation. And then, I think most people would be willing to put up with that one big burst of inflation if they knew on the other side of it that we were going to be on a sound money standard. And that's the critical part, right? We've got to return to sound money.
Now, risk happens slowly and then all at once, as you know, and we're seeing the stock market with a lot of turbulence lately. And you believe it's eventually going to crack. So, to your point just a second ago, will that be an opportunity at that point to fix the system, or will we see the usual stimulus monetarily and from the
Well,
side?
yeah, that's a great question, Mark. I mean, so it appears to me that clearly things are cracking, right? I mean, this Trump thing, he threw a grenade into the globalist system, and you can argue whether that's right or wrong. I mean, in a way, it kind of had to be done. And he was handed a bag of shit by the prior administration. I mean, it's a very, very messy situation that the economy is in right now with all this debt, and so we've got this big equity bubble, but really an everything bubble built on all the free money that they put out there. And so, yes, it's hurt the equity market, which I then think is going to hurt the bond market. And to me, we're really in it right now. We're back into, this feels to me like the summer of '08, where, things are starting to break, and they're going to continue to break. And then eventually they're going to really break. And that's going to lead to an enormous print. And so yes, I mean, we are, and hopefully that enormous print will create enough pain that the politicians and others will, and all those who read my book will stand up and say, hey, this is completely unacceptable. We've got to go to sound money. That's what's got to happen. That's, the thing that's really missing in the conversation and politics in the world, in my opinion, is the underlying problem with the money. I mean, all the teams, are red team and blue team, are all arguing about a bunch of stuff that doesn't matter as much as having a sound money base layer.
Now, Larry, as far as gold, we know it's near all-time high. Most of that demand is coming from central banks and out of Asia, but there seems to be a consensus that the Western world, the generalists, are not really participating just yet. Do you foresee that happening?
I think you're right. I mean, I'm starting to see signs, Mark, that they're participating. We're starting to see, some growth in the underlying ETF size of GLD and other things. But we've seen, anecdotally, there's some stuff in the States. I mean, Costco started selling gold bars. Whenever they get them, they sell out really quickly. So there's some people who get it, but you're right. I mean, most people don't. And I think most people have been very blissfully unaware of this problem. But I don't think that's going to last. I think that, as you've noticed, and I've noticed, gold is relentlessly pushing to higher highs. It's up 60% in a little over a year now. I just wrote my quarterly report, which will be out on Twitter later today. The only other time that's happened was 1979, when it was up 125%, and that was really a dollar crisis. I remember my grandfather thinking the dollar was going to fail, and that's when Volcker came in and put interest rates up to 20%. And he was able to do that, but he was, partly able to do that because the debt at the time, U.S. government debt, was only 25% of GDP, and right now it's 125% on balance sheet, and larger if you consider all the the off-balance sheet obligations of Medicare and Social Security. So it's quite a mess. And sadly, it's quite a mess. And a lot of people, I think, I know, people I talked to are like, well, gold's in a bubble. And even the gold mining analysts were saying, well, gold's at 2,500. Well, yeah, it's at 2,500 now, but it's going back to 2,000. Well, it was interesting to me, just recently, we've started to see major investment banks realizing that, oh no, this is something different. We are actually in a changing monetary environment. And Goldman Sachs came out and said, it's a possibility that gold's going to go to 4,500. I was kind of shocked. I think if you ping Goldman a year ago or a year and a half ago, they'd have said, oh yeah, it's at 2,300. It's going back to 2,000. So I think what's going on, Mark, is people are beginning to become aware. We're in a sovereign debt crisis. I've described that. People are beginning to become aware of what that is. And then the implications of that are that, you can't pay too much for gold. With both gold and Bitcoin, I've had friends say, well, I can't buy it now. You bought it at $1,000 an ounce, or you bought Bitcoin at $15,000 a coin. And I say, well, flip that on its head for a moment. Let's just say that the fiat monetary system is the Titanic, and the gold and Bitcoin are seats in a lifeboat, which you really want if you were on the Titanic. And so I paid, $1,000 and $15,000, and you got to pay $3,300 and $85,000. But do you want the seat or don't you? Because the alternative doesn't look great. I mean, and I may be overstating it there, because it's not certain this monetary system is going to fail. But what I do have a high level of confidence in is that the monetary system is in trouble, and that there's almost no way out that's not inflationary. I mean, there is a way out, which would be to just have a complete collapse. I think that the powers that be will never allow the system to collapse. When pushed against the wall, they always print the money, and they always will.
Larry, the gold silver ratio is around 100 right now. And as you know, when that happens, which is not that often, silver usually outperforms at some point. So what's your view of silver right now? Will it catch up?
Yeah, it will. I love it. I'm loaded to the gills with silver, both personally and in my fund. It will catch up. As we all know, it's a little bit of a dual metal, and its stock to flow is not as good as the gold stock to flow, because we can't add production, but it also gets used constantly, and the Chinese are using it heavily in the solar panels, and there's a lot of talk about it being used in automotive batteries as they develop these new solid state batteries. And so yes, I'm an enormous silver bull, and it's kind of stunning to me that it's the one commodity that hasn't even hit its old all-time high. I mean, the Hunt brothers pushed it to 50, and in 2011 it went to 50, and we're still kind of stuck in the low 30s. I'm just shaking my head. I don't get it, but I think it could be manipulation, it could be a lot of things. But I think when it breaks through 33 to 35, it's going to just go like a scalded dog. And I've got a target north of 100, well north of 100, in the next couple of years. So the implications of that for all the silver miners just are stunning, because most of them are now making pretty good money at these prices, and without their costs going up as rapidly as the price of the metal, they're going to just print money. So yeah, and we've seen this before, Mark. I mean, gold moves first. It's the big market, and silver moves latter and then further. And so this pattern is not unusual to us. We've seen it before.
When you say loaded to the gills, what percentage of your fund or portfolio is silver?
Well, it's hard. So as most mining investors know, there aren't that many pure play silver companies. Most companies have some silver, some gold, some everything else, some copper, whatever. But I would say that if there are some pure play silver companies, and I would say that they probably represent 25 or 30% of our portfolio. And because there aren't that many of them, that makes the weighting in each one pretty high. We tend to not want to be over 3, 4, 5% in one given name, but in the silver space, we're over that in a couple of names. So. And then personally, I've got lots and lots of ounces of silver. It's a great opportunity, but it's also much more volatile. And gold is money. Gold has always been money. Silver's money too, but it's at a lesser level. But what'll happen is, as this market develops, as we all know, the average person is not going to have the money to go out and buy an ounce of gold at 3,300, but everyone can buy an ounce of silver, and people will do that.
Just a quick question here for my own interest. If people hold precious metals, what percentage do you think should be physical, that they actually hold themselves?
I think a high percent. I mean, I think, what you're kind of alluding to is that I think there is paper gold and paper silver in the world. I think some of the ETFs don't have what they claim to have. I've always trusted the Sprott ETFs. PHYS is the gold one, and SPLV is the I think it's SPLV. The silver one, I'm not sure I have the ticker right, but I've trusted those. I personally, I own most of mine in hard form, and that kind of implies that you might think the system might totally fall apart. But I kind of look at it like possession is 9/10 of the law. I also look at it from the standpoint that owning it in hard form, the government doesn't necessarily know you have it. There might be longer term tax implications in terms of estate planning and so forth. I leave that up to everyone else to make their own decisions on. But you can participate in the price if you buy a trustworthy ETF, and I think the Sprott ones are. But even those, like, let's take a really bad example. Let's say Canada goes totally socialist, and they decide that silver and gold are bad, and they confiscate those ETFs. I mean, it's not. Roosevelt grabbed all the gold in the U.S. in the Depression in 1930, and it's not as if governments haven't done bad stuff before. And if you have the gold in your own possession or the silver in your own possession, the government could say, I want it, and you can say, well, I had a boating accident, I don't have it anymore, or good luck trying to find where I put it. So I like self custody more than having it in somebody else's vault. Or, well, a trusted vault is probably fine, but even the trusted vaults, the government knows where they are. So there's a certain benefit to just plain old self custody.
All right, very interesting. Thanks for answering that. And just for clarification, yeah, PSLV, that's the Sprott Physical.
Yeah, thank you. I had it wrong.
Now, you run a gold fund. How do you go about choosing the stocks? I understand you break them into 3 buckets.
Yeah, I do. So first of all, I should say, and just point out to anyone who's not familiar with this area, and most of the guys listening probably are, but investing in gold and mining stocks is very difficult. I mean, it's a difficult business. You're breaking rocks. You've got to get the geology right. You've got to get the expenses right. Got to get the permitting and the country right. I mean, there are all kinds of things that can go wrong. But I have 3 buckets that I invest in. The first is what I call producers. The second is developers, and the third are drill stories. And I lean heavily towards the producers, and I'll explain why. The producers, generally speaking, well, the ones I buy they have a mine. They are producing metal and they are generating profit. And what that does is that immediately or that greatly lowers the risk that they need to dilute your position by issuing new shares. And so, the sweet spot of the producers, I mean, you can buy the really big ones, and some of the big ones are great. I mean, probably one of the biggest ones, and I think it's very well managed, would be a top position is Agnico. I also like Kinross, but some of the others that are big, aren't as well managed, and some of them aren't really growing. They have a hard time replacing their ounces. I think the sweet spot of the producers are the slightly smaller ones, where they don't have as hard a time reproducing what they've mined, and they also are growing their production, and it's easier to grow it percentage-wise off a smaller base. So to me, the sweetest spot in the market is a company that's not necessarily big enough to have gotten institutional attention, but they're doing it right. They're making money. They're growing, and maybe in many cases their cash flow multiple is the market cap to cash flow is much lower as a multiple than the big guys. I mean, Agnico is a great company, but it's not cheap in my book. So emerging producers that are cheap are probably my favorite, risk-adjusted reward area. But even those, there's only so big they can get, and you're not going to get 50 baggers in that category, or even some cases, unless they really grow and prices go up a lot, 10 baggers. And so to get even more alpha or the real upside, if you want to absorb more risk, you get to the next 2 categories. They are the developers, and these are companies that have a proven resource. They've drilled enough of a deposit to know that it is potentially a mine, or they believe it's a mine. They've done the work to prove that it could be a mine. And what they're trying to do is further, increase the resource and pull together the financing in order to build the mine and turn it into a stream of cash flow. And of course, there are lots of risks there because, it could cost more, take longer. The design could be wrong. I mean, Murphy's Law applies at all of those steps. However, the market cap reflects that. In most of these cases, they're much cheaper. And if they are successful in getting through those challenges, they're going to end up, you've got companies that will end up worth $300, $400, $500 million that have market caps today of $50 or $60 million. And of course, there's going to be equity dilution as they raise money to build the mine. But the point is that the large multiples of your original investment can be made if the management team can pull it off. And that's a big if, but I try and pick the best teams. The third bucket is the drill story bucket, Mark, and that's where you've got some smart geos, some good land, a trend, or in my case, I really won't do anything that doesn't have a good discovery hole. I'm not investing in kind of moose pasture where we think maybe there's some gold. Most of the things I invest in they've discovered some gold, but maybe not a lot. But they can geologically see, and maybe map out and project a story that shows that if they drill it some more, that 0 ounces will become 1 million or 2 million or 5 million or 10 million ounces. And and as that can grow. They can get these deposits can get pretty big and then get pretty valuable. And so you've got drill stories you can make a lot of money in drill stories if you get good people, good land at the right stage. Then they get to be a certain size and it's hard for them to go up. This is the Lassonde curve where, okay, so you've proven to me you've got a 5 million ounce deposit. What are you going to do with it? How are you going to build it out? How are you going to mine it, et cetera? And so the fully mature drill story is maybe something you want to be careful about getting into until it's a little further along and being a true developer. But the early stage drill stories, good people, good dirt, you can generate significant returns. But you can also strike out. I mean, you can lose all your money easily. I mean, by the way, you can lose all your money easily in all these investments, and that's why it's really important to have, a basket of them. You just can never go all in on one gold mining stock or silver mining stock, because you just don't know. And I've seen ones I didn't think would work that did, and I think on things that I thought were absolute, slam dunks, and they didn't. So, and what keeps you out of trouble is if you pay the right price in each of these three buckets, you have this asymmetry, which is to say that if they fail, you can only lose 1x, but if they work, you can make 2 to 30x. And so you're going to have a couple that are going to fail. It doesn't matter how good you are, you just can't predict. But, as long as you got 10 of them and a few of them make 3x and a couple others make 4x and maybe one makes 30x, you're going to blend all that together, and it's going to be a pretty good return on your money.
Right. So you mentioned Agnico and Kinross. Presumably you own those. Did you mention a developer name and a drill story name?
No, I could. I mean, I hesitate to mention one name. I'm happy to, mention a few. I mean, self-interested here. I'm on a developer name that I like, and I'm on the board of, is Cabral. I think they've got a great project, great team, etc. I'm also involved with a company called Getchell, which is a developer, a good one. I'm just investing right now in Lahontan, which is a developer. But I mean, I could give you a list here of 20 names. If you want me to list them off, I'd be happy to do it. Over on the drill story side, I'm on the board of Lavras. I think it's one of the most exciting deposits I've seen in a long time. They're just getting going on proving how big it is. I think Terra's doing a great job at Banyan. It just represents incredible value. There's 9+ million ounces there, very easily mineable, and the market cap's quite low. I was in Collective and still am in Collective, but it used to be cheap. It's not as cheap as it was. I think Aries got a fantastic company. It's interesting. Eric Sprott was big in Newfound, and I wasn't for a while because it was too expensive, but they came out with their recent resource and it really got beat up pretty badly. And I've actually been coming back into Newfound because I think it's cheap, and I do think that's a good deposit. I'm in a company called Southern Silver, which is a fabulous silver deposit. It's a drill story turning into a developer. I think all of these have a lot of alpha, and they've all been vetted for kind of decent people, etc. But just to give you a sense, Mark, I think it might be helpful to the listeners. I mean, I'm probably 65% in producers. The risks in swinging for the fences is fun, but you got to be. First, swinging for the fences in shitty companies doesn't make any sense. They're just not going to work. But in the better ones where I feel like you have a fair bet. I mean, you still lose, but at least the team and the situation's good. That's probably 30%, 35% of my portfolio. Developer and drill. So.
You mentioned Southern Silver. That is a Red Cloud client, and we've interviewed them many times. Now, what about some of your silver names, your favorite silver names?
Oh, gosh. Yeah, there are a lot of them. Well, development story-wise, I like Silver Storm. I like Silver Tiger. What else is in there? Development story. There aren't a lot of pure silver development stories. But in terms of operating businesses, I really like Adriatic, the way it's shaping up. I love Aya. These are probably Red Cloud clients. I love Discovery Silver. I mean, it used to be a pure silver development story. Of course, they bought an operating mine. Makuch is involved. I mean, it's a very high quality situation. It's not as cheap as it was, but we've had a good ride there. I like Endeavor Silver a lot. I really like Keith and what he's done at First Majestic. The acquisition, of the gold mine didn't work very well, but they'll fix that. I think Fresnillo is a great silver company. I think Go Gold is a great silver company. I like Guanajuato as a silver company. I own a lot of Pan American. I own a lot of Coeur and a lot of Hecla. Those are all very good silver names. And you can't really go wrong when you've got a silver producer that's making money selling at a modest, multiple. Oh, one I didn't mention I really love is Avino. It's not as cheap as it was, but I still love it. It's a production. They're a producer. They're generating cash. They're growing production. The multiple's still very reasonable. That's one of my largest holdings actually in the silver space. So, there are just a lot of names, and I mean, I think one thing people should understand is that I own probably 100 names in total. I weight the best names more heavily, and I do trade in and out of them. I mean, I try and find them when they're cheaper, and then if they get fully valued, I'll take my weighting down a little bit. I mean, a good example of that is Collective. I mean, I think I've got a 3 or 4 bagger in it, and it's a great deposit down in South America, run by Ari Sussman, and it's run hard. It's up quite a bit, and I think from here it's still got probably 2 or 3x in it, but the 3 or 4x I've gotten thus far, that was easier money, and so I'll take the weighting down when something like that happens.
All right, lots of names, lots of ideas there. Full disclosure, you mentioned Avino. I happen to own that one personally. And just for disclosure purposes, Larry, all those names you mentioned the last 5 minutes or so, you own?
We own every single one of those names, but I can sell them at any point in time. So, but they are in the portfolio today, yes.
Okay, let's switch over to a Bitcoin. I have a couple of questions there, and then we'll get to some Q&A. We have the one waiting on Bitcoin as well. So is the main overriding reason you like Bitcoin because there's a finite amount, 21 million will only ever be produced, and that's by 2140, I guess it is.
That's correct. You've got it right, Mark. I mean, the fact of the matter is that Bitcoin, in my opinion, and a lot of people disagree with me on this, a lot of gold people disagree, and I respect their disagreement because there are concerns and there are risks, but Bitcoin to me is a form of digital gold because what the algorithm that Bitcoin represents did is they created immutable digital scarcity. Everything digital, like a music file or video file, a computer file, can be copied infinite number of times. But here we've got a ledger that they created that's proven for 16 years and 890,000 transactions to not be hackable. And to me, that's enough proof that these 21 million coins in the Bitcoin network are scarce. They're legitimate digital scarcity. And ultimately, even gold gets diluted, not fast. I mean, it's only 1.7% a year added to the existing supply, but, there will only ever be 21 million Bitcoin. And, the use cases for it are growing, and the ease of verifying it and moving it around, are pretty high, particularly when you compare it to gold. I mean, we don't even know if Fort Knox has all the gold they say they have. We don't know how much the Chinese have. I mean, gold is tougher to transact in. It's analog sound money, and it's been around for 5,000 years. It'll always be the first form of money. But I would submit to you that in today's world, we're moving into a digital world. And, the people who invented Bitcoin, we don't know who they are. I have a suspicion who they are, but the people who invented Bitcoin created immutable digital scarcity. They invented it. The only risk to me in Bitcoin is that the technology fails. And I think the odds of that happening were much greater in the early years, before all the patches and the things, the hard forks and the block wars and all the things that occurred. And now we've really kind of settled down to just a stable network that every 10 minutes puts out another set of transactions. And so it's my belief that more and more people are going to come to see that this is a decent form of money, that it's a substitute for money. And money has always just been a ledger, just keeping score. I mean, you don't really have the dollars you have in a bank. You just have a computer entry at the bank. So, and that's even before gold existed. Money was a ledger. In caves, people put marks on walls, or there's Sumerian tablets where people were writing down amounts, and there wasn't even a currency per se. They were just, this is X amount of wheat, and that's how they kept track. So money's a ledger. Bitcoin is a digital, immutable digital ledger, and it's scarce, and the demand for it's going up. I mean, we can see that, and therefore I think that's. I'm hard pressed to see what's going to change that, Mark. I mean, if somebody came to me and said, well, suddenly everyone's going to lose interest and not want to buy this thing, explain why. I mean, if that became true, yeah, then, I mean, it's only money because we all agree that it has value and it will grow in value. But, the number of people who have that opinion is growing every year. And that's why it continues to make higher highs and higher lows. I should add, I really think it's important that Bitcoin and gold are really sending a very strong signal that fiat currencies are failing. I mean, it's the sovereign debt crisis is real, and this is in my book, and it's actually, it's in my quarterly report as well. I mean, since 2020, Bitcoin is up 2,000% in sovereign bond terms, and gold is up 200% in sovereign bond terms. And sovereign bonds, the U.S. Treasury bond, used to be the base layer of the financial system. And they're failing, they're really failing. And so I think that, the book talks about this. I'm trying to help people, the people who, in light of what's going on in the macro world with this sovereign debt crisis, people who are not in, sound money alternatives, gold, silver, Bitcoin, are going to suffer, compared to everybody else. And it's been a long time coming. I mean, I've been a gold bull for a long time. It's been a brutal trade, and the book talks about that. But I actually think we're about to get paid in a very big way, perhaps more than we ever anticipated. And it feels to me like that's coming right now.
You said, Larry, that in the next decade or so, hard assets are the place to be. And as part of that, even though it's not hard technically, you think Bitcoin can go up by 10x. So
really do.
let's call it $850,000 in 10 years' time. Is there a math behind that?
There actually is. Yeah, and I encourage people to get the book and read it. There's a chapter in there where there's a piece of work done by some guys, done by a really smart guy at Stanford, PhD. They looked at the Bitcoin price back to inception, and they mapped it on a log basis, a log of time and a log of price. And they created kind of quote unquote a power law model based on these two log lookbacks of the price. And what they found is that the data fit the model 97% of the time. That means an R squared of 97% of the time. So anyone who's worked with data modeling knows that kind of an R squared, that means that model is actually predictive. Okay, it's not just some random, the model says it's going up, therefore it's going up. It's like if back testing it shows you 97% correlation, well, then it's not crazy to think that on a go forward basis it will follow that same model, and I believe it will. And that's the model that, and it's 5 to 10 years out, but that's the model that predicts these much higher prices. And there's actually a part of the book has a nice part on that explains it, and then it shows you to where you can go to see an update on the model in real time. So yes, I mean, I'm not just pulling numbers out of my butt. I mean, there's actually a model based on what it's done that suggests that this is what it'll continue to do. The one thing we don't really know, Mark, the one piece that's missing from both that model and the gold and silver price is we just don't know how bad and how irresponsible the government will be. I mean, there could come a time when, the dollar just totally fails. I mean, there's those people who say, well, maybe gold will go to $100,000 an ounce. Well, fine, and perhaps gasoline will cost $1,000 a gallon. I mean, at some point in time here, you kind of get into, well, these prices all get kind of nutty just because if we print the money so aggressively, the money will trend toward worthlessness. Do you know what I mean? And then we'll have to find some new form of money, which historically is what's always happened after you have a hyperinflation. And I mean, hyperinflation is terrible, and I'm not predicting it's going to happen, but it's not a zero probability. And if it does happen, we're going to have to do a reset to a sound money standard. And really, your only choice is gold to start with, and then as time develops, I think it gets more broadly accepted, Bitcoin is a choice as well.
Well, I'm glad you're not just pulling numbers out of your butt. That's good to know. But as you know, there are many people out there who have these wild figures for Bitcoin with nothing to back it up. Let's get to a question here. This is on Bitcoin. It's from Surya. He says Bitcoin responds to events and macro trends like risky equities. If you view Bitcoin as a hedge against the failings of a fiat monetary system, does it first need to stop behaving like a barometer for risk-on sentiment?
Yeah, that's a great point, and very observant on the part of whoever asked the question, and that is true. It's kind of a liquidity indicator. And it's been a punt for some people who are big into the NASDAQ and meme coins and all of that. I actually think it's a risk-off trade someday. It's like gold. It's sound money because you can't print it, but that's not what the market has said to date. And it's behaved in a way that's been very highly correlated with the triple Q and the risk-on piece of the liquidity market. We've begun to see a little bit of that changing, and there's some charts out recently that show that change ever so slowly starting to take place. And we'll know. I think in this next cycle, actually, we'll know. I believe the stock market is set up to tumble another 20 or 30% in the next year, and yet I don't think that Bitcoin's going to follow it down there. I think that because to me, and there's some great work on Twitter that shows that gold moves first. Gold smells monetary debasement first, and then Bitcoin tends to follow through and come after gold and go more aggressive than gold. And so when the money printing starts, and so I think that as the stock market falls, that'll create further trouble with the deficits. That'll create trouble in the bond market, and then the Fed will come in and do what the title of the book is. They'll do a big print, and that'll take gold to 5,000, and that'll, at some point, Bitcoin will decouple from that falling stock market and will go to a much higher number than it's at right now. I mean, my prediction is we'll see 140 sometime in the next year. So it's at 85 right now, and we were at 106 at the peak in December. So but it's a great question, and there's so many things that are changing, and people say, well, Bitcoin's too volatile to be money, and Bitcoin's, the volatility scares me. And there's a part in the book where I talk about this. If you go back and you look at the volatility of Amazon from the time Amazon was formed till today, and by the way, it's been probably the best performing stock ever in the history of the world. It's up like 288,000% since inception. Okay, this is Amazon, because it's the worldwide network-based Walmart. And so if you look at the history of Amazon's prices, I mean, it was volatile as you can imagine. I mean, there were multiple 50, 60, 70% drawdowns. In 2018, it went down 90%. Or I mean, sorry, 2008, it went down 90%, in the GFC. So, and yet it just kept going higher because the network effect of Amazon was more and more people would sell there, more and more people would buy there. And so, notice that Bitcoin is a monetary network. And so as more and more people join that network, more and more people transact there, I believe it'll exhibit the same kind of characteristics that Amazon exhibited.
Very interesting. I'm just looking at Bitcoin's price. The last month, amid all this volatility, it's actually fairly flat. U.S. dollar is down about 3%, and gold is up about 10% or so. So let's wrap this up, Larry. Any final thoughts? Any words of wisdom or advice?
No, I mean, obviously, I'm selling books. But surprisingly, Mark, you don't make much. You make a couple dollars a book. I'm selling books, and the reason I'm selling them is I wrote this book to try to educate everyday people as to why the system is stacked against them, and they're feeling so bad about their economic condition. And then and that's the bad news, and I lay it out very clearly, chapter and verse, how the system has been cooked against them. But then the good news is we can fight back. And how do we fight back? We advocate for sound money. We advocate for a return to the gold standard. We advocate for a return to a Bitcoin standard. We advocate for ending the Federal Reserve. I mean, it's the printing of money that's caused the misery, folks. And so, and this is a political matter. And the people who benefit from it, the bankers, the quintillionaires, the billionaires, the Federal Reserve officials, et cetera, we've got them outnumbered massively. And so if we could somehow get the entire world to understand that this is really the problem, well, then I think what will happen is some politician will stand up and say, the problem is the money's no good, and we're getting screwed because the system is broken. Let's change the system to a fair system. And all the voters would go, yeah, that's what we want. And they'd all vote for it, and we'd go there. So I would plead with people to, if you believe in that and you think I'm right, read the book. It gives you a very powerful weapon for explaining it to anybody. And then, pass it along, and let's try and get a big ass political movement, pushing to return the world to sound money so that my kids and grandkids can afford to buy houses and stuff. I mean, right now everything's so broken, it's pathetic, right? So,
Larry, do you have your book there to hold up?
Oh, I do. Yeah, I can hold it up. I mean, I'm sure people can find it. It's on, just so people know, it's on Amazon. Okay, it's shiny. You can. Yeah. It's in 3 formats. It's hard copy, or 4 formats: hard copy, paperback, digital, Kindle, EPUB, and then there's an audio. If you've got the 12 and a half hours, you can listen to an audio. I have a friend who said, "Oh, it's not 12 hours for me. I listen at 2x. It's 6 hours." I don't know how anyone listens to something at 2x.
But, me neither.
But anyway, yeah, there are lots of ways to consume the book. So, and I think it'll help. If you're puzzled about what's going on in macro land right now, I've heard the feedback has been that this does a good job of explaining it. So I'm pleased to have gotten that feedback.
And you did a great job today explaining the history of the monetary system, how it's broken, the solutions. You gave us some company names as well. And we really enjoyed this conversation. We'll see how everything plays out. Thanks, Larry.
Sounds great. Thank you, Mark. Thanks for having me on your great show.
All right, good stuff. Larry Lepard, our thanks to him, author of the Big Print, and also he is managing director at Equity Management Associates. Thanks for joining us today. We'll see you next time on one of these live core conversations.